Hi everyone, welcome to Workshop 5 doing Chapter 7 and 8. Chapter 7 is Accounts Receivable and Chapter 8 is Depreciation. Make sure you have your study guide in front of you as we go forward. Let's go ahead and get into Chapter 7 and talk about Accounts Receivable. First thing is, whenever we have been recording an account receivable over the past 4 or 5 weeks in the course, what has been our entry? Well, it's been debit account receivable, credit sales. What type of accounts are these? This is an asset, somebody owes us, and this is a sales revenue account. Okay, if we had received it for cash, the debit would just be to cash instead of account receivable. Now, what is our problem here as we're looking at Chapter 7? The problem is, not everybody is a good Bible-believing Wesleyan and does not always pay their bills. So, account receivables, some of these are going to be uncollectible. So we might have had sales on account of $300, but we're only going to collect $290 or so. So how does that present a problem? Well, if we only recorded the sales of $300 on our income statement, what's our pluses on our income statement? Well, so we have plus $300 for revenue. What do we have for our expenses? Well, we haven't done anything for expenses, so we have zero there. What's our net income? $300. Well, are we actually going to receive all of this $300? Well, probably not, because we know part of it is going to be uncollectible, or at least based on our experience, we're going to assume that part of it is uncollectible. So that's why we have this chapter here to show us about the allowance account. Now, there's two methods for accounting for uncollectible accounts. The first one is a direct write-off method. The second one is the allowance method. We'll spend the most of the time on the allowance method because that is the correct GAAP way to do it. Why is it the correct GAAP way to do it? We get back to our matching concept. Okay, now if we did the direct write-off method, that is where we only write off our accounts receivable whenever that account is deemed uncollectible. So when we know that account is no longer going to be collectible, we know for sure, and we actually write that off. What would be our entry there? We would do uncollectible accounts expense, and we would credit accounts receivable. So let's say that 10 of these are uncollectible. We would debit 10. And credit 10 right there and there. So the problem is, if this is a direct write-off method, this could occur in 2010, this could occur in 2011. Remember, our matching is our overriding concept here. We want to include expenses in the same period that the revenue occurred. So we're recording the revenue in 2010, but we're not recording this expense that's really associated with the revenue because we're not going to collect all of this $300. We're not recording that revenue under the direct write-off method until the following year. So here's our matching concept. Are we doing a good job with matching? No, we're not. So the direct write-off method, just remember, is not GAAP. That's all you really need to know with it. From now on, we'll do the allowance method. And what the allowance method does is it sets up a contra asset account to go with this account receivable. So if we're going to make T accounts here, let me go ahead and erase this up here. Remember that we have the 300 debit to account receivable and the 300 credit in sales. So in 2010, we made that entry. We'll have accounts here. Account receivable has a $300 debit in it. We're going to set up another account called allowance. Allowance for uncollectible accounts. And what this is a contra asset account. This has an opposite side entry to what account receivable is. So together, this is going to show the net that we deem are going to be collectible. So if we have 300 here and we put 10 in here, for example, we would say that 290 are going to be collectible. And then on the balance sheet, you would see account receivable less allowance for 300 minus 10, and you would see net AR for 290. Sorry that's so small, but you get the idea. Okay, so that's what our allowance account does. Now, what we're looking at here in the rest of the chapter is how we're actually making entries to this allowance account, the account receivable as well, and then our uncollectible accounts expense. So remember, from our direct write-off method that we talked about just a minute ago, we have this other account, uncollectible accounts expense. Sometimes you see bad debt expense. This is an expense that's going to have a debit balance. The allowance, like I said a minute ago, is going to have a credit balance. So whenever we set up our allowance, this is our entry here. We debit the uncollectible accounts expense, and we credit allowance. We'll put 10 in there for the time being. Okay, that's our entry. So this is basically an adjusting entry. At the end of the period, we're going to make an adjustment based on what we'll get into in a minute, how we calculate that. What actually happens when we write off? When we write off the account. A minute ago, when we did the direct write-off method, we wrote it off directly to this, and we didn't even mess with an allowance, right? So now we already put it into the allowance. Essentially what we're going to do is we're going to take it out of the allowance. So a minute ago we credited allowance, here we debit it. Okay? And what is our credit? That goes to account receivable for the 10. Okay, so we set up the adjustment in 2010. Here in 2011, whenever it actually gets written off, that is where we're going to take it out of the account receivable and the allowance. So what is the income statement effect of this? This is the whole reason we're doing this. Well, in 2010, we made our entry for 300 for the sales. That's a plus. Here we got an expense for 10, minus 10. So our net income is a 290 for the net. So that's the reason why we do this, okay? Now, there are two methods that we look at for how we actually make this entry up here. We're going to get rid of this entry down here for the time being and just look at our adjusting entry for 2010. Okay, first method is the income statement approach. Okay, and this is usually the percentage of sales. Okay, and the second statement, the second option is the balance sheet approach. And this is either going to be an aging or analysis of accounts receivable. Aging of AR. Okay, now essentially the difference is under option 1, we want to have the most accurate income statement that we can. Under option 2, we want to have the most accurate balance sheet that we can. Because this entry here is affecting an income statement account and allowance account, we basically pick which one we want to be more accurate, whether we want to have more accurate up here under the income statement or whether we want to have it on the balance sheet and under the allowance account. So let's look at the first one, percentage of sales. Essentially what this would do would say what percentage of our sales that we made during the current year are uncollectible. And for example, let's look at that 300 a minute ago. If we, based on historical experience, said 3% of our sales are going to be uncollectible, our entry would be 9. Okay, this is a very easy calculation to do, very easy entry. Okay, it doesn't matter what's up here in the allowance account. In a minute, we'll get to this allowance account. But when we do the percentage of sales method, all it is take your total credit sales for the period times what our uncollectible rate is, and that is our entry. 9 there, 9 there. Okay, so under allowance, say this had a pre-existing balance of 20. Okay, we just ignore that basically, and then we credit the 9 more, and that would be 29. Okay, now let's look at the aging option.